All righty. Again, hello and thank you so much for joining NFI Solutions today for this presentation. We are super excited for you to witness part one of a live demo for Agency Rocket's powerful platforms, the Debt Action Plan, and my retirement. Today will be centered on their Debt Action Plan designed for eliminating your client's debts. Today we are joined by John Phillips, President of Agency Rocket. John has spent many years developing marketing and sales systems for insurance agents like you, Debt Action Plan and My Retirement being one of the more popular ones. He has worked across diverse industries with notable specialization in the field of financial services. And just a couple of things here before we begin. This webinar will be recorded, though the recording will not be released until after part two, which again will go through their other platform, My Retirement, and that will show tomorrow at 11 a.m. Central Standard Time. You can request a copy of these webinars by calling into 952-887-1239 or email marketing@nfisolutions.com. There will be a Q&A session at the end of the presentation, so if you have any questions, feel free to pop them into the Q&A chat, which will be on the right of your screen here. And that will be all. All righty. Take it away, John.
All right, sounds good. I hope everybody can hear me. I'm going to go ahead and just jump right in, if you don't mind. Let me share my screen. And right, nope, not that one. Oh, yeah, that one. Okay. Oh, it only shares the one at a time. Oh, interesting. Okay. Well, here we go. This is well, let me share it a different way. I'm sorry, guys. Not super used to this platform. Let's do this one, and window. Very good. Okay, now we got it. All right, so this is Agency Rocket, okay? This is the system we built to help agents in market kind of things that are hard to market, okay? These are advanced products. You can use life insurance to do all kinds of wonderful things besides provide a death benefit, okay? There's a lot of living benefits that it provides, and our two systems take advantage of that. We have two systems that we offer. One is the Debt Action Plan, which we're going to talk about today. One is the My New Retirement System, which we'll talk about, I believe, tomorrow. The Debt Action Plan helps folks get out of debt using whole life insurance, which is really, really fun and cool. The My New Retirement System helps folks set up a really awesome retirement that blows everything else out of the water, and we'll prove that. You'll see that tomorrow as well. So those are our two systems. Each system, though, has three components to it. We're going to go over this in just a second, but there's a reach component. What is reach? Well, it's a prospecting tool. This is where you would send your clients to. They would get educated. They would see an intro video, and then they would register or put their name and email in to watch an extended video that has more details. Once they do that, once they register, we grab their name and email and we shove it in Tracker, which is a CRM that's built into our system automatically. And then you can work the lead and move them through different stages of the sales process. And then Analyzer is where we close the sale. Okay, that's where we present the strategy to the client. Okay, so those are the three components. I'll go ahead and X off of this. Once you have signed up, you'll be here and you'll see Reach, Tracker, and Analyzer, the three major components right here. Okay, I'm going to talk about Reach first. So we'll click on Reach. We'll go to Debt Action Plan at the top. And here's the Debt Action Plan Reach pages. First off, let me show you some settings real quick. You can put your name and company and license number on these reports. So we're going to have settings for the report. We're going to have branding on the report that'll be generated eventually. You can add colors and logos, your pictures and things for the website that you're going to have, which is I'm going to show you in just a second. And then some calendaring application stuff that we'll talk about as well. Maybe that's a little bit more advanced for right now. So back on the website tab, this is the website links here. We have two different types of pages that you have for you. One is called opt-in pages. These are for your cold contacts. These are folks you don't know. So we're going to ask them for their name and email before they can view anything significant. Okay. Then we have appointment pages, which are for your warm contacts. The difference is we don't ask them for their name and email. We assume that you've given this to somebody you know, and it has all the information they need right there. They can actually schedule a meeting right there on those pages as well. Okay, so let me show you what they look like. Here's the intro page. Intro page has a 2-minute webinar that they watch, and hopefully they sign up for an extended free webinar. Okay, this webinar, this 2-minute intro, just basically says, here's how most folks spend their money. Let me play a few seconds of it real quick.
Hey, John, I don't think that the audio is playing.
Uh-oh, no audio. All right, well, shoot. So I'll give you a little bit of a hint of what's going on. This is how most folks spend their money in their lifetime. Okay, they'll put their money into taxes, entertainment, and these kind of things over here. This is the lifestyle expenses. So your bills, food, entertainment, everything. On the right side was taxes and interest. Most advisors focus on that left side. They'll say, let's shrink that down. Let's eat beans and rice. Let's don't do anything for a few years and take all the savings that from all that spending and put it into your debt and stack them up, snowball or whatever, and knock those out as fast as we can. And then after 5, 6, 7, 8 years, then you can finally breathe and live kind of a normal life. The problem with that, though, is that a lot of times folks that are in debt have kids, have a family, they're living their life. It's really hard to squeeze that down, especially during those, I have 5 kids, okay? They have all left the house except for one. I would hate to have gone through the last 7 or 8 years of not spending any money. They would have missed out on sports and homecoming, all kinds of things, right? So life happens. It's really hard to squeeze those things down. And what we're saying to the client here is that we focus on the other side. So we ask them the question, which side would you rather focus on? Would you rather cut back on the side on the left or the one on the right? Okay, so that's the one that most folks will say, yeah, I'd really like to cut down those two things. Sure, of course. And so what happens is I'm going to just put in, I don't even know, John test. Look at all these testing ones I've done. Test 5, 4, 3, 2, 1. Okay. And I'll say John, blah, 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 at Gmail. Just a test, right? So we're going to view the webinar. Just going to kind of store that. Okay, so now we're on the webinar page. I'm not going to show you this whole thing. It's 12 minutes long, but what it does is it shows them how they can set their finances up like a bank, how they can earn interest guaranteed all along the way. They can borrow from that interest, which is the cash value within the whole life policy. They can pay off their debts. They can do all kinds of things with it. It shows how the money kind of moves, where the savings are, how this whole thing works. And then they're invited over here to set an appointment if they would like, if you've set up your calendaring widget. So they have more information here, and the hope is that they will contact you now. Okay, so that's how the reach pages work. The appointment pages are the exact same thing. Let me just show you what this one looks like. The only difference is there is no, hey, we need your name and email. You just click this button here and view the webinar. That's the only difference. Okay, but you won't collect any information from them. Okay, so now let me go to Tracker. Now, once they have registered, look, you see this John test 5, 4, 3, 2, 1. That's the one that was just created. It has the new flag on it. Okay, so it automatically shows up in Tracker, where you can then drag and drop it to different stages in your pipeline. Okay, and if you look at the top, you go from left to right: lead, contacted, webinar viewed, debt info collected, appointment, and all the way to policy delivered, app submitted, right? All these things here. So you can actually follow this case and move the case along, and it organizes your business. Now, all the cases are color coded. They're supposed to all be green, which is, so I'm really doing bad. But this is really neat about this page, is that you can see all your open cases on one screen. When I'm done with a case, I can drag it and drop it to won or lost, meaning I either lost the deal or won the deal. That's it. It doesn't delete it. It just removes it off this main pipeline page. I can still click on cases and view all my cases. Now, I just told you a while ago that they're all supposed to be green. So let's talk about how we do that. Let me click on this one we just created. It's currently yellow. It means that there's no planned activity. So they want us to create a new activity. So I'll do that. Let's say we're going to have a meeting, go over details. I don't know. We'll do that Friday at 12:15, and it'll take us 30 minutes. Well, maybe an hour, whatever. We save that. Now what's happened is it's turned green in the background. If I go back to my pipeline, It's green. So that's how we turn it green. We actually want to create an appointment in the future. So a case that has no appointments at all is yellow. That means that you're kind of sitting still, nothing is moving forward. Green means there's something in the future and the system thinks everything's A-OK. Red means that you have an appointment that you did not mark as complete. So it's in the past. So either you forgot it or you just didn't mark it as complete. So you go ahead and fix that. So training and your day-to-day operations is really easy. Get in here, turn everything green. You do that by creating new appointments and fulfilling them. Okay, I hope that makes sense. All right, so that's Tracker. There's a lot more I could show you, but I won't because it's not the really sexy part of the program, to be honest with you. We have notes and history of everything and all kinds of fun stuff. But I'm going to show you now the debt action plan scenario. Okay, so I'm on the debt action plan scenarios tab. I can watch a training video which goes over exactly how to do this. This is for the agent, not the client. This shows you how to work the system. But I'm going to click on the new scenario button right there. And what happens is it creates a new scenario, and I can go back to that case by clicking that little arrow there. But we're going to now make a new scenario. And this is where all the magic happens, guys. This is what you really want to see, all right? All the other stuff, which is kind of what all other things that we have, this is where the thing gets really awesome. So we're going to go in here, and we're going to add mortgage debts. So you're going to meet with your client. They're going to know you're going to talk about debts. You're going to, I'm just going to say house. They know that you're going to be asking them for information that might be a little sensitive. $400,000 principal on that home. Interest rate was 7.5. I used to put like 3, but it's not that anymore. It's like 7.5 now. It says my minimum payment is $27.97, but you would look off on their statement. Now, when you look on their statement, you put the principal and interest only. We don't care about all the other things that are added, like the escrows and insurances and whatnot. It's just principal and interest. So look on their statement, P&I only, pop that in there. Now, right here, any overpayment to principal, you can put right here. Most folks are not making additional payments to their principal, right? If they have consumer debt, they're usually throwing extra money there. They don't make extra payments to their house note. Some do. If they are, you would put it there, and it would be listed as a $100 inefficient mortgage overpayment. And it'll be listed here and listed here again and listed up here again. It's all over the place, okay? So what you do is you can say, well, here's the $100 that's available. We want to take all 100, or we want to just take 50 of it to put into their bank, whatever, right? The system allows you to do whatever you want. I'm going to actually get rid of that because it's not typical. And I'm going to show you this little button here. First of all, there's a little number here that says 89.29. That is the effective interest rate of this loan. What does that mean? Well, $2,800 is the monthly payment at this moment in time, which is they have 359 months remaining. So this is in the beginning of their mortgage. 89.29% of that payment is going to interest. Holy cow! It's not 7.5; it's 89%. Okay, if I view the amortization, we actually amortize the whole stinking loan here. So they're gonna pay over $1 million for this house once all the interest is done and all the look at the interest. They're scheduled to pay $603,000 of interest and $1 million for that home that was only $400,000. Crazy. The effective interest rate over the life of the loan is 60% because in the beginning it's a lot more interest. At the end, it's a lot less interest. The average is going to be 60. Watch this. This is every single line item. Now, I won't go over it, but here's the effective interest rate every month, and it kind of changes, right? Because less money goes to principal, or more goes to principal, less goes to interest every payment. If I go down for like 15 years, guys, and I listen, this is a bunch of numbers. This is ugly. This is not really the presentation. I just wanted to show you real quick, so bear with me. Halfway through, 15 years, 1 month, boy, we're still paying 67% of our money to interest. You don't get to the low numbers until the very, very, very end, right? And that's where we're going to use a lot of the savings, is some of those interest savings. Most people don't know that. And by the way, most folks won't get 15 years into this loan. Most of them will either refinance and start the whole clock over again, thinking they're saving money, but they're actually paying more interest because they're starting the whole clock over again. Or they'll sell the home and start another loan somewhere else, right? So we'll never get to that 7%. We're going to be paying that 60s, 70s, 80s the entire time. Sad, right? Okay. Now we're going to go to the consumer debt tab. By the way, we're going to move from left to right until we get to the fun ones at the end. So we're going to add a few debts here. I'm just going to start making up debts. Okay. Visa. Maybe we have $9,000 on that thing and the rate is 22%. Tells me my minimum is 255 that I need to put in there, but you would put whatever it says on their statement. Now we get to a really important question. That was the minimum payment on the card. What is the actual payment? Not overpayments. What are they actually paying? Because we assume they're making more than the minimums. And I'm going to assume that here. Okay, 260 is what the minimum says on my statement. I actually round that up to 300 every month, which is what a lot of folks do. Again, you can amortize this if you'd like. You can defer the debt, you can add an intro rate, all kinds of fun stuff. We won't go into that right now. Let's just hustle through here and add a few debts so you can see the magic at the end. We will say Amex. Okay, maybe there's 7,000 on that one. Oops, I said 7,000. Interest rate is 25%. Minimum is 215. So let's go to 16. Overpayment on this one is let's say 316. We're adding $100 to it. I'm going to add probably one more consumer debt here. Let's say this is a big one. Maybe there's $19,000 on that one. His rate is 19%. Bucks. He's putting an extra $100 there. If you guys are noticing, it's just subtracting these two numbers and totaling it here. So now we have $240 of inefficient overpayments, which is what we're going to collect and put towards the monthly redirecting money, which is the monthly premium on the life insurance policy. That's what's going on here. I'll add one more debt. Let's say there's a truck payment. I could add all kinds of stuff like student loans or whatnot, but we'll just go ahead and say there's $25,000 left on this truck payment. Interest rate is 7.5. Minimum is 415. And he rounds that one up to 500. So he's doing a little bit of overpayment towards his debt. So now we're $325. We'll go to the next tab. Investments. Some folks have them, some folks don't, but a savings account is an investment. Okay, we'll call it a savings. Maybe there's $5,000 in there and he's putting $200 a month into it. So let's say he's putting $300 a month into it. Okay. So if you notice here, we have a different line item here. We have monthly redirecting and now lump sum, which is cash. So it assumes that you could maybe put that $5,000 towards their bank if they wanted to. Let me add one more. 401k. Qualified account. Maybe there's 50,000 in there. And they've been putting $300 into that one also. Okay. Now, I'm going to do something a little different. I'm going to say, let's just, as for a scenario that we're going to work through, let's take the $300 from both of these and leave it in there. Let's go ahead and put that in their bank and see what that looks like. Instead of contributing to these two things, let's contribute to their bank and see how much love we can get. I am going to, though, put this down to zero. I'm going to let them hang on to that $5,000 in their savings account. We could put it in the bank, but I just want to leave it kind of conservative. I'm not going to take any of their cash out of the 401k. That would incur probably taxes and probably penalties and whatnot. So let's just leave that alone. You might want to do that, but I'm not for this scenario. Income sources, you can add an income source if you want. Let's say he works at Target and he's making $7,000 a month. I don't know what Target pays. Probably not that much. Okay. And then if you wanted to put more money towards the bank, you could put it here. You could just say, I'm going to put an extra $500 towards it and it'll add up here. But I'm not going to do that because we've told Mr. John Test that I'm not going to take any extra money from him. I'm just going to redirect what he's already doing. So I'm not going to ask for more money. Let's go to insurance policies. If they have any insurance policies, you can add them. Let's say he's got a term policy here and monthly premium is $75. And death benefit is, I don't know. What does that buy you? 500, that, whatever. I don't know. Okay, so here you could also take their monthly premium into the bank or any lump sum, which would be any cash value. This term policy doesn't have cash value in it, so there's nothing there. But if they had one, you could do that as well. And what you would do is obviously you basically shut that policy down and they would make the monthly payment towards their bank now. Their new strategy, their bank, right, has an insurance component, so they will be covered with that death benefit potentially. So you just make all those determinations. Now, I've done all this, guys, because I wanted this to be exactly $1,000 because I have an illustration ready to do that. So I'm going to go on the report page, and this is where you upload the illustration. Now let me stop. Just think about what I just said. Go to the carrier's website, put an illustration together for $1,000 a month, and save that PDF file to your computer and upload it directly to our system. That's all you have to do. No copy, no pasting, no nothing. We read that whole darn thing. Let me show you how cool it is. I'll do upload file, $1,000 a month thing here. It's going to upload. It's going to take it maybe 10 or 15 seconds. And it's going to parse all the data in that thing and grab all the numbers it needs and put all this math together for you in like super fast. Boom, there it is. Okay. Now, there's a lot of stuff that showed up. First off, here's the illustration. I can delete it. I can download it. I can add a new one. So I can do multiple illustrations for the spouse maybe and the husband, the wife, whatever. But right off the bat, we get an instant readout. Remember, we were supposed to pay $1 million roughly on the home. Well, plus all the other debt, it's like $1,083,000. All right. It's going to take 29 years and 11 months for them to pay that debt off on their own. They told you exactly how they're making their debt payments every month, right? Well, our new plan is going to have that done in 13 years and 5 months. We're going to save them $228,000 of interest. Whoa. Wow. Are you kidding? So now your client is seeing that and going, that sounds exciting. I have no clue what the heck you're talking about, right? So let's talk to them about it. So first off, that's not even optimized. Let me come optimize this for you. So the first thing I want to talk about is payoff order. Right now we're paying the house off first, which makes no sense. We need to pay these little things off first. So let's click on Snowball, which orders our debts from the smallest principal first to the largest. So we ordered them. We looked over here, and it's now $246,000 in 13 years and 2 months. So let's see. I want to remember this: 246, 627. If I go Avalanche, which orders them from the highest interest rate first. Oh shoot, it's the same exact order. Oh well, I should have done a better job entering my debt. So these make no difference. They're both smallest principal to the largest, and they already ordered from highest interest rate to the smallest. Okay, so but Avalanche is that. Well, Avalanche orders it from the highest interest rate first to the smallest. Happens to be the same exact order. My bad. Should have made these debts a little bit better. All right, so there's our savings. We're still not done. There's some settings here that we can talk about really quickly. You can set a start date for the report. Okay, we're going to say it's going to take 6 months to pay this thing off. Well, what date are we starting from? So we can give them an exact date. Well, it's actually going to be October 5th, blah, blah, blah. Okay. A savings account interest rate. I'm going to talk about that in a minute. But there's going to be a point in time where all these debts are paid off. We're going to shove the payments you were making towards these debts into some other thing, which we call it a savings account. We put a little teeny tiny conservative 2% rate there. You're going to call this a life insurance product at a much higher guaranteed rate. But I'm going to be conservative here and put 2%. Percentage of cash value. This is going to work like a home equity line of credit. Okay. If you have $100,000 of equity or cash value, they usually don't let you borrow all 100% of it. So there's a limit there. So 95% is the normal. You can adjust that to whatever your carrier prefers. We're going to be borrowing money. Okay. That's part of the strategy. I'll talk about the strategy in just a second. There's going to be an interest rate associated with that. Right now it's around 5% for most carriers, but it could change because our economy is crazy. And that might change. So you can adjust that. Emergency fund. We won't talk about that in a minute, but we won't talk about that at all. That's just kind of a different thing. I won't talk about these two as well. Leave them unchecked. That's not the normal strategy. This one is though. So with the whole life insurance, you get dividends as a policy holder. Those dividends are technically not guaranteed, which is why we have a toggle to include them or not. But most of these companies have been paying them for like 100 years, and they didn't pay them way back in the day when it was like the Great Depression, right? Maybe missed one or something, right? But they're going to get these dividends. We leave them as a toggle so you can show them with or without. I'm going to go ahead and put them on there. We'll see this change. Give it a second. Oh, we're now at 254, 12 years and 10 months. Look at that. Okay, now we're ready to go, guys. Now let's talk about what in the world we're doing. How does this strategy work? The first thing that we're doing, you've noticed that already, is we're collecting any overpayments. Anything above and beyond the minimums for all their debts, we're going to grab that, put this into their bank where we get a whole lot more love. Instead of putting it straight to the creditors as extra payments, we put it in their bank first where it grows, and then we put it to the creditors as a secondary thing. Okay? Really important. As you do that, oh my goodness, it just transforms their life. I mean, you can see the difference here. Let me show you how this works. On the comparison tab, my favorite part about the software is this comparison tab. What we have here is we have their current plan. Before you met them, this is the blue, and their debts are listed in order. The debt action plan is what we're suggesting, and here's their debts in order. And we're going to show how these two strategies differ as time progresses. Up here, we have a monthly slider, and as I move it, you'll see that things change, okay? As I go into month 7, all we're doing is making minimum payments. Remember the Amex were making a pretty substantial overpayment. So on their current plan, we actually have a larger progress. They're 18% done paying that card off. The balance is currently 5,731. Over here, we got 64. We're only 7% done. Why is this slow? It's supposed to be a good thing, right? Well, it's slower on the debt side right now because we're only making minimum payments to everything. Over here, they're making overpayments, so they're going to go a little faster. Remember, we're comparing the two strategies. But in month 7, we have this bank over here. The bank has $6,100 of cash value accumulated already. Oh my gosh. And if you look at the balance of the Amex, it's 6,400. So when we dump in the next month's $1,000 and we get the interest credit for that $6,000 sitting there, it's going to trigger our first loan, a policy loan. We're going to borrow against the cash value, take out a loan to pay this off. So watch, in month 8, here it goes. Bang. So now we have a zero balance on the Amex. It's 100% paid off. And if you look over here, we have a new thing. It's a policy loan for $6,300 roughly. Okay. Now, the first piece of love we get is that we traded a 25% interest rate for a 5% interest rate. So we get a little better interest savings, yes. But, and we'll talk about this more in a minute, the real key here is that this cash value keeps on earning about 5 or 5.5%. I don't know what it is right now, but about around there. It depends on the product. It's earning a guaranteed interest rate every month. So think about that. We're paying an interest rate here and earning an interest rate there. If we're paying a 5% and we're earning a 5%, doesn't that kind of cancel each other out? So if you think about it, yeah, we're paying, but this one's earning the same amount. Now, how do banks make money? A bank will take somebody who has a lot of money, or all of us actually, they'll take their money and hold it into a savings account or something else, and they will pay out as little interest as possible, okay? Maybe it's 1 point, 2 points, maybe zero interest, right? They'll take the same money that you put into the bank, they'll turn over here to another person and say, you can borrow this money that we have that belongs to that guy, and you can borrow it at a much higher rate, 20%, let's say. They're paying like 1 and they're earning 20. So there's 19% in the middle. That's what they're earning. That's what they're making. That's how they make their money. Taking the same cash and lending it out. Okay. You're doing kind of the same thing. You're earning interest here and paying it out on here. Right now, these numbers are almost exactly the same. But guys, in a minute, this number is going to get really high and that number is going to fluctuate up and down, up and down. It's going to be zero. And you're going to start going crazy. Let me show you. We're going to keep on going here. Okay, nothing else happens in month 12. We're going to make our minimum payment here. Actually, let me go over that. The 216 that we were making towards the Amex, we make it towards the policy loan. So we don't do anything different. No more money, just the same minimum payment we put over to this other loan. It's not Amex. It's now from Foresters or Lafayette or whoever you're using. All right, next year, nothing. Okay, look, something just happened there. In month 3, this has gone down a little bit from that $216 payment every month. But look at this, it's grown. Whoa, that's a lot of growth. We have $8,200 of room now when you take that minus that. It's going to trigger our second policy loan because we have a $7,300 balance on the Visa. So watch, when I move the next one, bang, paid off. This loan is increased. Okay, we're earning on the 14, we're paying on the 12, canceling each other out. And we're canceling out that big 22% rate there. Let's keep on going. Okay, nothing else happens the next year. Same drill. Okay, this has gone way up. This has gone down a little bit because we've combined the 216 with the 260. So that $550 or whatever that is, we've been paying towards the policy loan. Now we're going to go to the next one. The next one is a big one. It's a $12,000 one, and we have $14,000 of room. Here we go. Bang. Our loan went way up, but we get to add $500 to our monthly going to this policy loan. So we're going to gain a little momentum here. Goes down, down, down. Oh, look at this. We're just 2 years, 9 months in, and we got $16,000 of room. Our loan has gone down. This has gained $15,000 here. Let's go ahead and pay that one off. Bang. Zero. We've increased our policy loan here from the balance that was on that truck. And I want you to think about this for a second. In 2 years and 10 months, all of our consumer debt is gone, besides the home. Now, some of you are very smart and you're seeing this big, huge negative $28,000 there in red, right? You're still getting a bill in the mail for $28,000. So I just told you your debt's gone and you're saying, no, it's not. I'm getting a big, huge chunk of debt from someone else. I just traded debt from Visa and Discover to the insurance company. Yes and no. If you were to call up the insurance company today and say, I only wanted to pay off my consumer debt without my home, um, I'd like to close this thing out. They'll take your cash value, subtract your policy loan, and give you a check for $3,000. And you go home and all your debt's gone, except for your home. Okay, if that was your strategy. But let's not. Let's keep making these debt payments. Let's pretend we're still in debt and make all these payments, combine them all together and make them towards that policy loan. That'll knock it out pretty fast. It's 25 grand. Let's keep on going. Looks like around year 4, they're all gone. Okay. Year 4, even the policy loan is gone. So now we have $63,000 free and clear with no debts. So we don't have a policy loan anymore. So there's nowhere for that extra money to go. So now we open up their second branch, which is another insurance policy. We're going to be putting 415 plus 500, that's 900, plus 200, 1200, plus another 200, that's $1,400 roughly, into another policy. And it's going to gain cash value. I have this growing at 2%. We're being very conservative. It could be a whole lot more. And watch, I'll just have that grow. As we make those payments, have it grow. Now, when I get to year 12, which is when we quoted them that they'd be out of debt with our plan, this monthly slider shows up. So I'll go ahead and go to that one. Actually, I'll go 1 month before it. Okay, 1 month before, I want you to take a look. We got a bunch of money in the savings account or the other life insurance that's growing at a lot faster rate than 2. We've got 183,000 of cash value. That combined is 331. We have a balance of 323 on the home, and guess what? We're going to pay the home off just like everything else. Bam. Because again, it's like a zero interest loan. We're earning and paying, right? Okay. This is the best part of the program. Well, actually, let me just drag it and show you a little bit. Obviously, we're going to start adding the house note, the big money, to all these other things, pretend like we're still in debt, and pay that same amount to that one debt. We've consolidated it all, okay? And as we do that, it goes down fairly quick. All right, so it looks like in year 16, we're out of debt again, and we're back up to put money in the savings account. Okay, when there's nothing to go here, you put it into the other policy or the bank account or wherever it is. Now watch. Let's pretend we're still in debt. Let's pretend we're still on that same path of 29 years and 11 months. Just pretend that you never met this person, but they're putting that money into these banks instead of paying their debt directly. This guy shows up here, so I can drag it all the way to 29 years, month 11, which is when they were scheduled to be out of debt. Remember? Because they met you, and because you just did one thing, you said, let's route your extra payments into the insurance policy and then take out policy loans to pay these debts off. Pretty simple strategy. That one thing that you did, you guys want to look at that number right there? They have $1.4 million. Their current path had them out of debt in 29 years and 11, but with no money. They're finally out of debt with no cash. You've got them out of debt in 29 years and 11 months, and you've got them $1.4 million on top of it. So that $1.4 million feels like it came out of the sky for your client. They're like, wow, I was on this path, and you just had me tweak the strategy slightly, and you found me $1.4 million. Are you kidding me? Now, I know that's awesome, but let's back it up a little bit. Let's say, I don't know, year 20, they have $500,000 of assets here. They can borrow against that. There's no debt, but they can maybe renovate their home or maybe invest and put some of that into rental properties or buy an RV or buy a boat or whatever and borrow against their bank. Again, it's almost a 0% interest situation, right? Because when they borrow against it, it stays in there and just keeps earning and you're paying the interest rate at the same time. So it kind of cancels it out, right? So what we teach our clients is to not use traditional banking in the future. Use your bank for everything. You don't have credit checks. Nobody asks any questions. You say, I want my money. And they say, oh yes, sir. Here it is. It's a completely different thing. You can use this money towards your retirement, create a tax-free retirement by borrowing against it in your retirement years. There's all kinds of wonderful things you can do when you have that money sitting there in your policy and in cash value. Okay. And that's the basics of the strategy. I hope that makes somewhat sense. Now I'm going to go to the report page again, and I'm going to generate a report. It's going to generate it, and it's going to turn into a different button here. There it goes. Now you download the report right there. And there it is. Okay, so I put a little maroon color and I put a your logo in there, but that would be your colors for your agency. My name, disclaimer. We get right down to business. We're going to save you $254,000. We're going to have you out of debt in 12 years, 10 months. It uses modern banking principles to quickly eliminate debt and build wealth. It's not magic. It's just math combined with a few incredible strategies, blah, 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 blah. Right? This is marketing language here. Here's the difference between the two. How are we doing this? Well, we identify inefficient payment strategies, which is what our software does. We start making minimum payments to all the debts, put the extra payment into a uniquely designed life insurance policy where we build up cash value within the policy. Then we take out loans against that cash value to pay our debts off as the system tells us to. So there's 4 steps. Where did we get the money from? Well, from your insurance that we closed down, some overpayments from your debts, some payments you're putting into your 401k and your savings account, and it totaled $1,000 a month in your premium. Current plan, here's where all the money, here's all your interest is going towards. The red is the scheduled interest. Whoa, look at that mortgage debt. Ouch. The new plan, let me scroll in a little bit. You probably can't see that. The current date before they met you to pay the Amex off was 5/11/26. Now they're paying it off at 6/11/24. 27, 25th year, 27th year, 25th year, right? We're saving this much money on each one of their debts and a whole bunch on that home, right? Scroll down a little bit. We're not just saving them time and interest payments. We're also going to be building wealth. We're going to turn their debt into wealth, meaning we're going to take the debt payments, and if you just keep making them, it's going to turn that into wealth. 20 years, you have 500,000. In 30 years, you have 1.4 million. And in 40 years, you'll have $2.5 million in assets if you just keep the program going. In addition to that, you've got death benefit, terminal illness, chronic, all kinds of things, right? That's insurance language there. The important dates. Think about this for a second. They're going to pay minimums to everything and make their premium payment to the insurance. And then on 6/11/24, they're going to do one thing slightly different. They're going to take out a policy loan for the Amex in the amount of $63.95 and start making the $216 that we're paying towards the Amex towards the policy loan. And you're going to hold their hand through that entire process. You're going to call them up on that date or maybe before it and say, let's pay this sucker off. This is going to be fun. Okay, let's do it. And then you do it together. Then you do nothing until 2/10/11. You make your policy loan payment and all your minimums. That's all you do. Then on this date, Visa, same drill. You add that to that. Now you're making $476 towards the policy loan. The next one is the Discover, then the truck. And then on this date is when you open up that savings account, which could be a savings account, I guess, but it should be something a little more awesome, like a life insurance policy that would guarantee them 5-6%, whatever, instead of a measly 1% or whatever that is, right? So they know you're going to be talking with them because this paragraph talks about it. We'll determine the proper savings vehicle for your needs when you reach that date, okay? So that's a special date. And then this is when their home is paid off. So 1, 2, 3, 4, 5, 6 opportunities to touch your client, 6 times to do something different instead of paying minimums, and that's it. If they can follow that plan, they'll get whatever we just showed you, $1.4 million more at the end of that time period. Next steps, make the minimums, apply for the insurance. It's a nice, happy family there, and off we go. That's the report, okay? Let me go back here. Now, that's pretty much the whole system, but let me just make one more comment, and then we'll talk about Q&A and whatever you'd like to talk about. But I want you to think about, just for a second, what we did. We found a client that was in debt. Do you think if they had this consumer debt, that they feel like they're a good insurance candidate before they met you? They probably were like, hey, you know what, John, I know you're an insurance agent. I know what you're going to tell me is really important. I got to protect my family against an untimely death. And but man, I have all these debt payments. I just can't think about it right now. I'm kind of young. Let me think about that when I get older, right? It's an important conversation, but this guy is just trying to make keep his head above water and doesn't really want to add an additional debt, you represent one more bill to him. Okay. It's an important bill, but you represent one more bill to him. Now, this is a different way to approach this client. Now you say, you don't talk about death benefit. You talk about, I can get you out of debt. Really? Yeah, let's go through this scenario. And they found $1,000. Maybe the insurance product you were going to sell them before, but maybe it was 150, $200 a month, something like that, because that's all he can squeeze. We're not squeezing anymore. This is a different strategy. He has all kinds of overpayments that he was putting towards debts. Now he can put them towards this bank and get himself out of debt. It's a completely different conversation. And you can cast a much wider net, right, in your marketing efforts. And that's the beauty of this system. Sean will talk about the money retirement tomorrow, kind of the same principle. It's a different strategy of approaching people. How many people are in debt? Just about everybody. So you just opened up your marketing operation to everybody that you're going to run across. And guys, that is the end of the presentation. Now, if you guys have any questions, I'll leave this up. Actually, I guess I could stop screen sharing. There we go.
All right, and we did get a couple questions that came in during your presentation here, John. So the first one would be the illustration that you uploaded in your example. Was that a whole life illustration or an IUL?
Yes, I'm sorry. It was a whole life illustration. IUL, I guess you could technically use this for this strategy, but we really don't recommend it. IUL is wonderful. Whole life is wonderful. It's like a hammer and a screwdriver. They're just different. IUL is good over a longer period of time. The whole life is good for a short period of time. We get that guaranteed rate, and I can do all these different wonderful calculations because I know exactly to the penny what you're going to be earning every month. With an IUL, you don't. It's indexed, right? So it's wonderful because you don't lose any money. You can sit out those loss years, but you can only gain up to the cap of the index, right? But what if you have 2 or 3 years of losses in the stock market in a row? Your client didn't earn any money those 2 or 3 years, and they're looking at you like, man, I put all this extra money into this thing, and I haven't made any progress on my debts. What are you doing to me, right? So the IUL doesn't quite work right. It doesn't. The money's not liquid quick enough in the IUL, and it's more of a long-term strategy. Sherry, what carrier you're using? I'll let you guys worry about which carrier. I think this one was maybe a Lafayette or a Foresters or something. There's a lot of carriers that you can use with the system. We do recommend you using a participating whole life carrier, meaning that they pay those dividends, right? You as a policy holder, you get part of their profits, right? And so you get the extra love. You get the guaranteed rate plus the extra love of the dividend. That just makes it work even better. So I won't answer that what carrier you're using. The one that I uploaded, I think, was maybe Foresters or Lafayette. I wasn't paying attention, but I'll let you guys at NFI figure out the best carrier. That's not what I usually recommend.
Awesome.
Let me read the next one. I think I got this one. So,
Okay.
Can this process be used for someone who already has a policy in force, but entering their current information and then uploading the original strategy? No. The strategy can be used for someone who has a policy in force, but we don't have an in-force illustration uploading feature where we can kind of show you where you are right now. So that's kind of a bad answer there. Sorry about that. They can use their existing policy as long as it's set up right. There's some nuances to how to set the things up right. Okay, there's nuances to how to deal with the paid up additions and all that kind of stuff, and get you the maximum cash value without it becoming a mech. There's some things that you do there. So I don't know, Athena, if the policy they already have has those things that make it really grow that cash value as much as possible, et cetera. So I guess that answers that question. Kind of. It wasn't the best answer, but
just to kind of tack on to your nuances comment there, we did get a question about if there are any trainings offered on the platform, or if it's more so like hey, this is the information and this is how you input it, and then you just kind of run off to your client and give it to them.
Yeah, it's kind of that, honestly. Like we try to stay out of the case design world because we honestly don't want to get in trouble in that area. And that's up to the carriers and your IMOs and agencies and whatnot, and how they best like to do those things. We are a software vendor, so we do provide the software to make it all work and make it all look pretty and help you present it in a great way. But we don't give we don't give any training actually on case design and how you can do that. I kind of know how to do it, but we don't really train on that. We do train on the software, all you need, all the time.
Perfect. Another question that we had is you had mentioned that it will hold some client information there. They're wondering if this is a CRM or if it will eventually purge the data from there.
It's a CRM in a really basic, rough way. There's name, address, things like that. You can use it to do a CRM. Like we do have. I guess I can show you real quick. Let me do a screen share real fast. Window, that one. So in these cases, you can enter in policy numbers and face amounts and all this stuff. It doesn't feed from your carrier, so you have to update it yourself. But you can do that. You can add commission you're going to earn and premium so that you can kind of keep track of things. So there is some things that you can do on the CRM side, but it's really not super robust. It's just there to tie all these things together and give you easy access to all your scenarios, really. It won't send out emails for you. It won't do drip campaigns, that kind of thing. So does that answer the question? I hope it does.
I think it does, yeah. And then the final, it looks like another one came in. So it looks like maybe we've got two questions left here, but I'm seeing one that says, how do clients move from one stage to the next?
Okay, so when they enter themselves into the system, they move from they move into the webinar viewed stage automatically. Okay, so they put their name and email in. You can also, if they fill out the contact form on the website, they go into the contacted stage, which is a couple stages before that. You can actually enter in the leads yourself and put in whatever stage you want. They don't have to go through the website, for example. But once they've entered themselves in, you have to manually move them, because we don't integrate with your carriers or whatnot. We can't tell when the app is in force and whatnot. So you just have to move them. You do that, by dragging and dropping it and keeping up with that.
Perfect. And then we've got the $1 million question here.
How much money?
Exactly.
It's 5,000. No, I'm just kidding. It is no window. She's sharing the wrong thing. Okay, so pricing. We're going to talk about the minor retirement tomorrow. Okay, so you'll look at those pricing. It's $150 per month, but we have a 10% discount for NFI Solutions Group. Okay, so when you use a link that I'll show you in a minute, you'll have a 10% discount added to that and anything else you ever add on there. So this is the monthly. The other one's $59. If you buy this one and the one you're going to see tomorrow, you'll get it for $39 instead of $59. Sean will probably go over this combination pricing, but you get a discount the more stuff you get, and you get 10% off a coupon that will be applied automatically at the end of your checkout. You can also pay for it annually and get an additional 10% off of all that as well. So about $134, I think, $135 when you take the 10% off of this number is what that costs. And I hope that answered it. Did that answer it? $134 roughly. This is the retail you're looking at right now.
Yeah.
Okay.
But all right, I think that this is a good segment to kind of wrap up here. Thank you all for taking time out of your busy days to join us for this webinar. And again, part 2, showing the My New Retirement side, will show tomorrow at 11 a.m. Central Standard Time. This will be your ultimate retirement strategy tool, so you do not want to miss out on this. So keep an eye out on your emails for invitations to register, or you can definitely call into 952-887-1239 so that we can manually register you for tomorrow's webinar. Again, thank you. And thank you, John. And feel free to reach out to NFI Solutions with any questions or concerns. Thank you.
Thank you so much. That was fun.
All right.